If you pay any attention to financial news, you've probably heard the same line every time the stock market has a little whoopsie-daisy.
$58 billion wiped off the exchange today.
$136 billion was wiped off.
$5 trillion in value had been wiped from the markets in just 3 weeks.
Yeah, that's right. Every time green line does not go up, we are told some company or the market has lost, destroyed, or wiped out however many billions of dollars. But alright then, where does that money actually go? It might not surprise you to learn that headlines like this are written more for shock and awe than genuine insight. But the simple truth is that the money doesn't actually go anywhere, because it never existed in the first place. Sort of. If you can look beyond the flashy headlines like this and actually understand what they are trying to say, you are going to be much better equipped to make sensible financial decisions when everybody else is busy losing their minds and, if they are lucky enough, maybe even their retirement savings too. This basic understanding has probably actually never been more important than it is right now, because the stock market is breaking new records every single week. Nobody knows if or when the party will stop, but what we do know is that, in this particular case, the money doesn't actually have anywhere else to go.
$5 trillion in value had been wiped from the markets in just 3 weeks.
Gold prices hit a record high on Tuesday.
The dream of owning the house with the white picket fence increasingly giving way to white picket renters.
You could buy a house tomorrow if the price was right, if the interest rates were where they needed to be.
Help for the economy from Washington remains nowhere in sight.
So there are really 3 different levels of technical explanation for what happens to money during a crash. The good enough for most people level, the armchair market analyst level, and then the level that considers debt, consumption, and all the different asset markets that are getting kind of weird at the moment. Now, most people don't even get level 1 right, but I promise none of this is as complicated as the financial bros would like you to think. And actually seeing how these markets work is the only way to understand how messed up they really are at the moment. But alright, most of the time when headlines are talking about billions of dollars being destroyed or whatever, what they are really saying is that the market capitalization of a company or group of companies has been repriced. This is just calculated using the number of outstanding shares multiplied by the price the last share was traded at. So for example, Nvidia currently has about 24 billion outstanding shares, and right now those shares are trading at a price of about $170, which gives the company a market cap of $4.1 trillion. If for some reason tomorrow people decided to start trading Nvidia shares at $85, then it would have the market cap of the company and you would inevitably see headlines about Nvidia losing $2 trillion. But they didn't really lose $2 trillion. They were just revalued using this very crude calculation. Now, technically, this could actually help Nvidia's ongoing business operations. Since the AI boom, the company has been doing a lot of share buybacks, where they will use their profits to buy company stock off existing shareholders to take it out of circulation. They are only supposed to do this when management thinks the company is undervalued. So if their stock halves in price, they will get twice as many shares for the same money, which should be a good thing, right? Well, this is assuming, of course, that they aren't just doing stock buybacks to drive up an already hyped up stock. Part of what is making the current stock market so strange at the moment is that by far the biggest net purchaser of shares in these companies are these companies. According to the Fed's Z1 financial accounts, households made net purchases of about $100 billion of stock in 2024. This was dwarfed by listed corporations that did over $625 billion worth of net buying, meaning that companies were buying 6 times more of their own stock than actual stockholders were. Now, that doesn't seem great, but it's actually worse than it sounds. The whole point of a stock market is that it's supposed to be a place where companies can go and sell their shares to raise money to fund business operations. This net sales figure also includes the company subtracting from this net number by conducting IPOs. The total gross value of stock buybacks was over $1 trillion within 2024 alone. It just so happens that companies also raised about $375 billion in the same year. Now, this has helped to increase market capitalization by driving up share prices, but that's not even the biggest problem. It will actually get more important later on as we go into how asset markets are supposed to function. But for now, for level 1, a market crash is just a readjustment in market capitalization. Unless a company is planning to sell its own stock to raise money to fund future projects, its day-to-day market capitalization shouldn't impact its performance. Market capitalization is kind of like GDP. It's a number that we use a lot because it's sort of easy to calculate, and it's good enough as a rough indication of if things are going in the right direction or not. Now, a lot of people, when they learn this, take it to mean that market cap is irrelevant. A $10 banana is no better than a banana that's on clearance for $5. And while that's true, a sudden price drop on anything can be an indication that there is something rotting away beneath the surface. So for the next level of understanding, you need to do what the journalists writing the headlines aren't willing to do, and actually follow the money. Now, I know I just said that if a stock halves in value, that doesn't necessarily mean that any money has gone anywhere. But in highly liquid markets, such a scenario can only really happen one way. The Nasdaq doesn't get to slap a 50% off clearance label on Nvidia stock like Walmart does on questionable milk. The way the price moves in these kinds of markets is that if there are more sellers than buyers, the price falls, and if there are more buyers than sellers, the price rises. When people are panic selling stocks, they are still getting money in exchange for those stocks. It may not be as much as they wanted, but what they then do with that money is where things get interesting. Let's say you had some spare money. Yeah, I know, but just pretend with me for a second. With your pile of cash, you have some options. You can invest into the stock market, real estate, bonds, gold, alternatives like cryptocurrency, or you could just hold on to your cash. Alternatively, if you just want to enjoy your life right now, you could spend that money on goods and services like a new car, a bigger house to live in, or a nice vacation. All of these activities that improve your quality of life are generally classified as consumption. Depending on where you and everybody else who has spare money puts their cash, it will increase the value of these markets. So if everybody buys gold, its price will increase as demand increases on an asset with limited supply. Now, stocks, bonds, and real estate are kind of unique because they generate their own cash flow to give money back to you. Stocks do this through dividends, bonds through interest, and real estate through rent. Those cash flows come from other people deciding to put their money into the consumption pile, which becomes revenue for these three asset classes. But all of these other assets really only make returns by having more people buy in at a progressively higher price. When the stock market crashes, what is really happening is everybody trying to grab their cash out of that particular asset market. They do this either because they think the market won't generate as much cash flow in the future, or more often, just to get their cash out before everybody else lowers their price by taking their cash out. Now, if you were lucky enough to get your cash back before everybody else, you have a choice. During a lot of market crashes, people just want to hold on to their cash because they are afraid they will lose their jobs and nothing else is generating cash flow. But eventually, you will need to put your money somewhere. And that predicament is what is creating such a big problem right now. Sure, maybe you think that the stock market might be an AI-fueled bubble, but if you sell your positions, where exactly should you put your money? Gold is at all-time highs. Real estate is risky with today's interest rates, cryptocurrency is highly correlated with the stock market, goods and services are more expensive than ever, and people are even starting to question the long-term safety of the bond market. People are quickly running out of safe platforms to stand on, which has got a few people saying that maybe these markets aren't actually broken. Maybe it's the money that's broken. So it's time to learn how money works, to find out if money actually works. This video is sponsored by Odoo. Odoo is an all-in-one business management platform that brings everything under one roof. CRM, sales, inventory, accounting, manufacturing, project management, the list goes on. It's customizable, easy to use, and designed to make your business run smoother. What we love most is how connected it all is. You can launch a professional website in minutes, keep inventory updated real-time, automate invoicing with AI-powered data capture, and even use predictive lead scoring to help your team focus on the right opportunities. It's powerful but simple to manage. And we're excited to announce that we just moved our newsletter, Compounded Daily, over to Odoo. Handling subscribers, sending out issues, and tracking performance is all in one place now. And honestly, it's made the whole process faster and a lot more efficient. If you're looking for a smarter way to run your business, whether you're starting something new or upgrading what you already have, Odoo makes it easy. Try it out yourself. Use the link in the description to explore any app free for 15 days. No credit card required. The way that money flows in and out of these markets can have a big impact on the way that you live your life, even if you don't actually have that much in any one of these respective piles. Increasing housing prices have become a defining financial problem of young generations as people can't afford a place to start their own lives or their own families. House prices have outpaced inflation by a lot, which I know is not exactly shocking to most of you, especially if you have watched any of the dozens of videos we have made about the structural problems and broken incentives in the housing market. But the key here is that when we measure price increases relative to inflation, we are only measuring relative to the consumption pile here with the consumer price index. The problem with this is that it doesn't reflect the changing gaps between these other money piles. Real estate, for example, has grown faster than consumer prices, but relative to fixed assets like gold, it's actually gone backwards. An article published by Jonathan Hobbs, a chartered financial analyst, compiled this data to show that if you were paying for the average American house today in gold, you would be spending about half as much as you would have been back in 1991. and roughly a quarter of what you would have been paying in the early 2000s. Now, the article itself used this data to build a case for just buying gold. But the reality is basically any assets would have had the same effect. If you were paying in S&P 500 indexes, the relative fall in house prices would have been even greater. So there are two lessons from this. One is that investing is important. I hope you already knew that. But the deeper lesson here is that it's become much easier for people with lots of money in these piles to buy basically anything they want from these piles. There is only so much money that people can spend on consumption, so wealthy people naturally throw the rest into one of these. As they have grown, they have provided more money to people who own them, and since most of them were already maxing out what they could throw into consumption, they put even more back into these piles, creating a feedback loop of wealth generation. A basic look at the historic numbers makes this pretty clear. Market returns over the past 60 years have averaged just over 10%, and inflation has averaged just over 4%. If you include taxes, this generally means if you can consume less than 4% of your invested assets annually, you can live forever without touching your principal. This basic arithmetic is the foundation of things like the financial independence retire early movement. But for extremely wealthy people who can easily afford to live on less than 4% of their net worth, they can compound wealth faster than they can spend it. Now compare this to most people who earn their income by selling their time. Most wage increases are indexed to consumer prices if you are lucky, which has been the slowest growing one of these piles. This has made it harder and harder for the wages to compete when both groups want to put their money into the same area. A lot of what the wealthy are buying is different from what working people are buying, but there are some areas where these cross over. Real estate is just the most obvious and socially destabilizing example of that. The reason this is happening now is that the growth in these asset piles has become unprecedented. We have been paying a lot of attention to what the money printer has done to consumer prices, but these other money piles have soaked up much of the excess cash, and it has put non-asset owners further behind. Now, the point of this is not that inequality has become worse. You already knew that. But a new problem coming from that is how these increasingly consolidated markets are behaving. According to the Fed, participation in the stock market is approaching all-time highs, which sounds like a good thing. But this has mainly been driven by lots of people investing very small amounts of money through platforms with low fees and low barriers to entry like Robinhood. The real money in these asset markets is more consolidated than it has ever been, with the top 10% of households owning 93% of all equities the last time this data was collected at the end of 2024. In a market panic, the reason why people sell their assets is because they want to make sure they have enough cash on hand to cover their most basic consumption needs if they lose their source of income, which for most people is their job. Unfortunately, job losses and market downturns often go hand in hand. However, as these assets have become more consolidated amongst people who can easily cover their living expenses several times over, there have consistently been more people with lots of spare cash to buy in versus the people that need to sell out to cover themselves in a hard time. Put another way, if unemployment was to hypothetically spike tomorrow for any particular reason, most of the people losing their jobs would not have a meaningful pile of assets to sell to cover themselves while they were looking for a new job. And it's not like we would miss the consumers either. A majority of the consumer spending in the economy now comes from the top 10% of households, and corporate profits are primarily driven by selling stuff to other corporations. Sounds pretty bad, right? Well, it gets worse. Remember those record-setting stock buybacks from earlier? Well, they have outnumbered net household share purchases 6-1, adding even more people to the side piling money in. If you add this to the rise of index funds that mindlessly buy and hold a broad selection of shares, it's easy to see how lopsided the market has become. Now, this does not mean that markets can't fall, but what it does mean is that they can stretch far further and stay irrational far longer than they could ever before, and while they do, they are throwing off money like never before for people to buy up every other asset market. Sounds pretty bad, right? Well, it gets worse. A huge amount of this money recently has been tied up in chasing returns from AI. These companies have spent trillions of dollars on this project, so far. But watch this video next to find out how it's costing all of us just as much, if not more, and don't forget to like and subscribe to keep on learning how money works.